Well, thank you everyone for joining us. My name is Cameron Law. I serve as the executive director of the Carlson Center for Innovation and Entrepreneurship, and we're excited to partner with the Tech Futures Group on this four-part series. So today is our fourth session on investor readiness and talking about fundraising and climate tech. And we're going to have a great discussion, and we're looking forward to having your questions answered. So Paul will be getting those questions throughout the day from you, but he'll tee that up in a little bit. But for those of you that don't know about the Carlson Center, we serve as a regional hub and platform for providing approachable and accessible entrepreneurial education, community, and support to enable startup founders of all backgrounds to start and scale their businesses. And we steward a group called the Sacramento Entrepreneurial Growth Alliance, which is a group of entrepreneurial support organizations advancing entrepreneurship as a driver for economic development. And we're excited to partner in relation to the designation we got, which is called the Accelerate California Inclusive Innovation Hub. And through that, we are able to partner on this four-part series and provide you with some information on how you can accelerate your venture in the bio and climate tech space. And so just a little bit of housekeeping before I turn it over to Paul. We are recording this session, so we will be following up with this recording. Additionally, we will share a PDF version of these slides after the session as well. We have hosted all of the recordings on our YouTube channel, so you're more than welcome to go back and watch any of the sessions that you might have missed. But with that, we're excited to dive into the discussion, and we're really looking forward to having your questions answered. So please do engage and bring your questions, as we have an awesome panel today. So with that, take it away, Paul, and thank you all for being here.
Great. Thanks, Cameron. Well, it's good to be with all of you this afternoon for our fourth of four conversations around investor readiness. And today we're really going to be talking about fundraising. I'll talk about the agenda in just a moment. But just wanted to at least give a big shout out for Steve for driving such great content our first three sessions. So thanks, Steve, for setting a great example. And I hope to further the conversation with everyone today. So in terms of I really took to heart the topic of today, which is investor readiness, getting prepared to secure investment. And so that's kind of the theme today. The first three webinars, fantastic information, just amazing, great strategic, higher level strategy type of knowledge and concepts and information. Today, it's going to be a little bit more tactical, okay? And the way I constructed our agenda was really around themes I talk about every day with tech entrepreneurs that are nascent seed and early stage, that are launching companies, developing their MVP, their beta, their prototype, their first go-to-market, and they're talking about funding and building a company. So really, today's agenda is grouped around some of the common themes that I work every day with entrepreneurs and tech companies on these topics. So that's how it's kind of built, is a kind of a tactical conversation about important concepts you need to realize as you think about funding for your company. So a couple, before we get to introduction of our panelists, a couple of just kind of general logistical things. Your questions are valued and encouraged. So after each of my topics, I'll have just a question slide. So Cameron, if you could, since I'm in present mode, I can't really see all the chat. When we get to Q&A, if you could monitor for questions, that would be great. So Cameron, is that okay?
Sounds good.
Okay, perfect. And obviously let me know if I have any AV or tech issues, anything like that. And also too, on our agenda, we're gonna meet our panelists in just a moment, but this is a conversation. I'll be facilitating it. I'll be throwing out some themes, but certainly invite all of our panelists. We have a brand new special guest with us today to contribute their thoughts to the conversation as well. So I wanna try to make this as open and dynamic as possible. So in terms of our presenters, I will lead off very briefly. We do very quick introductions. Paul Bozzo, I'm with the Tech Futures Group. I've advised thousands of businesses, a large percentage of those technology ventures. I do a lot with strategy planning, go to market, business plan, projections, pitch decks. I ran a clean tech accelerator in the Bay Area for 3 years. So been around this sector for quite a bit. Steve, would you like to say a few words about yourself?
Sure. If you've been following along, I've done the last 3 webinars. Paul leading this one. In my day job, I run a small early stage venture fund in Silicon Valley called the Entrepreneurs Fund. And before that, I spent 15 years in a variety, operating executive in a variety of startups. And before that, 15, 20 years in consulting to technology startups. So we're in my sweet spot here.
Jeff, I think you're joining by phone. Are you online? Jeff may be joining us in progress. So you all know Jeff. He's been with us for the first part of the series. We do have a special guest with us today, Lee Rand. Lee, would you like to introduce yourself to the group?
Would help if I unmuted. There we go. Sure, everyone, happy to. I'll try not to take too long, but my background is computer science, math. So I used to be technical and do real work. Did a tech startup in Silicon Valley. Did consulting for a while. We ended up selling that tech startup to Intel. It was semiconductors. I spent a bunch of time at Intel in a variety of roles. Went back and got an MBA along the way, left, did another technology startup around semantic search, natural language, when that stuff basically didn't work. Now it's, everywhere and actually works. And from there, I went on to join a VC firm. Been doing that about 15 years. And I'm actually still active with 2 VC firms as a partner, but I also am starting to step back out into operational roles because I miss it and it was fun. That's me.
Great, Lee. Thrilled you're here today. Let's see, just a second here. I want to briefly go over our agenda. So the way I'm going to talk about it today, I've got kind of like 5 basic themes for today. 6 basically is first, a very general overview of kind of venture investment 101. So several important concepts about what it is, how it works, who these individuals or firms are, what they're looking for. So just kind of a broad overview of venture investment overall. I want to talk a little bit about how you actually identify and qualify potential investors for your company. So we'll be looking at some VC and angel groups and some strategies to really ensure that that particular VC firm or that particular angel is the right one for you. We're going to be doing a super brief overview of SBIR, STTR innovation grants. That's a whole big topic in and of itself. I'm not going to do it justice, but at least I wanted to alert you what it is and basically how it works, just so it's on your radar as an option. But certainly this is not going to be an exhaustive presentation on SBIR grants. I do a lot of work with startup companies on entity formation and governance. So I have several important concepts I want to make sure that you know about related to that process. We're going to do, again, it's a big topic, intellectual property. I want to highlight just a few things I think are important for you to know related to IP as you get ready to secure investment. And then we're going to do something fun. I think it's going to be fun, which is an investor speed round. I'll tell you more about that in a second. So first, a brief disclaimer. We are talking about financial matters. We are talking about IP. We are talking about legal entities. And I want you to consider this presentation as information only. It's obviously the best information I can present based on my professional experience. I try to source as much of the information as possible from third-party reputable sources, but please don't take it as gospel. Always consult licensed legal and financial professionals for all important decisions related to your company. And that's our advice to you as well. So investor speed rounds. This is our last conversation together. And I felt it was important that you had an opportunity to ask your questions. And so we're going to leave time at the end. It's an open amount of time. Our conversation today will take anywhere between an hour and 15 minutes at max. But I want to leave some space at the end for you to ask your questions. And we're going to do something I think that's going to be add some real value. If you think about our panelists, we've got, between myself, Steve, Jeff, who will be joining us, and particularly Lee, we've got an inordinate amount of experience working with funding for early stage technology companies. So what I want to do is they're going to be the investor panel. And essentially throughout today's conversation, so while I'm presenting, I want you to put your questions, any and all questions related to funding your company. And we're going to leave some space at the end for those questions to be answered by a member of the panel that feels particularly compelled to answer that particular question. I want it to be fast paced. I want it to be quick specific question, quick specific answer. So we're going to keep that kind of speed roundish. I'd like you to direct chat me those questions if you would, because I will be moderating the questions, and it's also a chance for you to ask any wild, crazy, what you think is a nutty question, and do it anonymously. Okay, so throughout today's conversation, any and all questions that you'd like to pose to one of our panelists at the end about funding, please direct chat those to me, and I'll wrap those up and moderate those at the end. Okay, so investor speed rounds, this is your opportunity to ask any question related to funding. Direct chat me. We'll circle back at the end for our speed round. So hopefully you'll enjoy that. So let's do a quick kind of 100,000 foot view of venture investment. So first, venture capital, there's a big myth out there. You're nascent technology, you have a concept, you're a single founder, and your belief is that you're going to be able to pitch a VC and secure $1 million in capital. That's not the way it works, and you're going to find out a little bit why that is in a moment. But you're going to learn what the true definition of venture capital is. That's a very specific type of funding. There's a lot of different types of funding around that. So when we think about securing capital from a venture capital firm, that necessarily may not be your first round of funding, or may not even be structural feasible at that time. So let's learn a little bit more about that. So the truth is, pure venture capital, and we're going to define that in just a moment, really is the exception for the vast majority of pure startups. Historically, a small percentage of VC investment has gone towards US startups. Again, there's some debate what percentage that is, but it's fairly small. Non-VC funding really is the main source of capital to start up early stage, pre-seed, nascent companies. And it's grown rapidly over the past. So as VCs have kind of moved up the food chain, other types of investment have filled the gaps. So really where we're primarily going to focus for most early stage companies is angel investors. There's a couple different flavors of that. We'll talk about that in a moment. But they are much more likely to invest at earlier stages of a company's progression. And actually, at that stage, that kind of early stage, and we'll define that in a moment, angels are 16 times more likely to invest than a venture capital firm. So it's important to think about your company and kind of what stage it's in. And there's a lot of gray in these definitions. So I'm not going to suggest that these are the only definitions out there. There's some different interpretations and different nomenclature and some gray in terms of this, but broadly speaking, it breaks down into some stages. So pre-seed can be defined as maybe you're validating your concept, your idea, you've got a business plan in place, you're getting the team together. Seed is maybe you have the prototype of your technology complete, maybe you've launched an MVP, you've done some initial market testing. Early stage, primarily you are at beta. It could be unpaid or paid beta. You've got some initial customers. Hopefully they represent your core target market, because you want to be able to validate product market fit and also your revenue model. As you move past early stage, you're really at that point, you're validated, and you're in expansion. You're securing partnerships, revenues starting to come online rapidly. You may be launching additional revenue streams. You're moving out of your initial markets and expanding into different markets. And then maturity, you're very profitable, or at least a high degree of revenue. And you kind of have achieved that dominant position in the marketplace. So it might be interesting to kind of think about those definitions and kind of place a label, if you will, on where you're at now and perhaps what that next stage for you looks like. So what's important about this is, for every stage, there is a viable funding source. And that's what we want to start thinking about, because it's not efficient to continue to try to pitch types of funding sources that you're just not ready for and that doesn't fit their basic investment thesis. So broadly speaking, again, there's lots of different exceptions to the rule. But broadly speaking, pre-seed, it's the founders that are putting in capital, friends and family. You may be getting a small grant. You may be qualified for an SBIR phase 1. We'll talk about those coming up. As you move into seed, friends and family still, grants, SBIR 1, perhaps SBIR 2. As we get into early stage, now you're moving it up into the accredited angels. We'll talk about those in a moment. You are beginning to hit the envelope for perhaps early stage venture capital, perhaps a later stage government innovation grant, expansion, more accredited angels, VCs, traditional VCs, strategic funding. And the maturity, it's late stage VCs, SBA financing, mezzanine, strategic. So at any stage of your company, there's the right funding source. And so it's important for you to know where you're at, what the next stages you're going to, the funding to get to that stage, and the appropriate potential funding source that might match up against your particular situation. If you are thinking about technology and kind of pitching that to the government, this is a useful thing for you to kind of know. It's kind of a way to also classify where you're at. This is called the technology readiness level. If I have my history right, this was originally developed by NASA, but it's been widely adopted by both the US government and also the European government as a way to identify where companies at on their level of progression to market. So again, it's just a way for you to kind of roughly categorize where you're at and where or what potential funding sources are most likely to fund your venture at that stage. So let's talk about what a venture capitalist is. And that's a very specific term. It's widely misunderstood. It's widely thrown out there. And we want to make sure we define what a venture capitalist is. So a VC is an equity firm, and these are managed by professionals. These are professional money managers that essentially take money from individuals, corporations, endowments, foundations, and they invest that in high growth potential companies. So VCs are professionals. They are investing other people's money, and they have a mandate, charter, and fiduciary responsibility to vet companies for the highest risk reward opportunity. So that's a little different than an angel investor, which we'll learn more about in a moment. So why does a venture capital firm invest in a startup? It's all ROI. I mean, yes, you do have certain VCs that like certain sectors. There are VCs that tend to favor investments that may have certain societal impacts or global impacts. But by and large, as a category, VCs are all about ROI. And they are looking for roughly about a 25 to 35% per year return over the lifetime of their investment. Average VC hold time, it runs anywhere between 5 and 8 years. So if you take 25 to 35% annualized for 8 years, I mean, they have to have a very, very high return on their investment to justify their particular role in your company. So we all want to think about, yeah.
Can I roll back one more? Just roll back
Please.
this slide. That 25 to 35% per year. I hope that's echoing with something I said in the first 2 webinars about VCs are not interested in a better mousetrap. It can't be better than something that's out there today, because you'll never get this kind of return on something that's better, incrementally better. It's got to be fundamentally different and growth oriented, or it's never going to clear the bar.
Absolutely. And Steve, thank you for that. And also a reminder to our panelists, after each slide, I'll take maybe a brief pause. If you want to jump in, add some context, please do. I want to make this as valuable for the participants, and all of you have great wisdom to share. So panelists, feel free to jump in at any time. So we all want to think about getting a VC's money in our company, but VCs are primarily thinking about how they're going to get their money out. And structurally, I think it's important for you to understand how a VC gets money out of their investment. There's primarily 3 different ways. 2 of them are preferred. 1 of them is not. A certain amount of companies, a very small amount of companies, will go public. So the moment a private investment in a company, the moment that company goes IPO, that private investment becomes liquid and can be traded on the open markets. So equity can now be converted to cash. That's a liquidation event. Okay. That doesn't happen a ton. It's a fairly rare thing. The vast majority of exits successfully for VCs happen through merger and acquisition. Why is that important for you to know? Acquisitions accounted for nearly 70% of successful exits in 2022. So why is that important for you to know? You want to understand what your path to exit is so that you can have a conversation with the VC about, yes, I'm talking about putting your money in right now, but let me share with you how that's going to come out. And it's important for you to understand what your exit strategy is. If it is M&A, can you provide relevant references to recent acquisitions, the multiples of those acquisitions, and make a case for why your company might fit that mold moving forward?
I would just jump in and add the one thing on that last slide, and maybe down in the weeds a little bit, but the whole idea of a secondary or selling off your holdings to another VC firm at a future round. And as it relates to people on the call, this is important because you could end up with an investor you didn't plan on, and it will have implications for your legal docs and how you think about structuring them. So just, I'd throw that one in the mix.
Absolutely. Great. Thank you.
Yeah. Hey, Paul, one other footnote too is this is Jeff joining finally.
Hey, Jeff.
The other thing I always remind people too is if you take a look at Silicon Valley, everyone says, man, there's hundreds of venture capitalists. My view is if you take a look at that historically over 30 or 40 years, 90% plus of the returns are made by about 5 to 10% of the venture capitalists. So to Paul's point, be really picky. There's been hundreds, if not thousands, of funds that have raised whatever, 20, 30 million bucks, and that's it. So just kind of be wary about that as you're, developing a target list of the different stages from pre-seed to kind of traditional A and B series investors out there.
Great. Thanks, Jeff. Glad you're on the call. So now let's switch gears. So that's venture capital. So we learned earlier that angel investors are 16 times likely to fund your company at earlier stages. So let's find out who are angel investors. So broadly speaking, an angel investor is an individual, not a professional money manager. and they're investing their own money versus somebody else's money in a startup in exchange for equity. So angel investors could be anybody. It could be grandma, it could be fellow entrepreneurs, it could be seasoned business people, part of your friends and family, introductions from any of those people, people in your broader network. But ultimately, an angel investor is an individual that exchanges cash for equity ownership in a company. Where it gets slightly different is what's called an accredited angel investor. And this is a little bit more your kind of Silicon Valley types. They actually meet a mandate from the SEC in terms of their ability to first understand the risk of a business venture and to handle the potential losses. So the broad criteria is an individual income greater than 200,000, not including real estate. Liquid net worth of 1 million, not including real estate. And here is a great article, and you will get a copy of this presentation. All these links are going to be live, so I'm just going to click on it, show it to you, and then click off. But I've got a really good article on an Investopedia that has everything to know about angel investors that you can use for your further information. So again, I won't go through this article. It's a great one, very comprehensive. And I think it's a good read to learn a little bit more about angels. So why do angels, individuals, invest in startups? So yes, most of them are looking for a return on investment. And that can vary. I mean, they could be hoping just to get their money back, or, yes, they could be hoping that this is a really great return on their investment. But also, typically what I find, and I'd be curious to see what our panelists think as well, is they have a affinity for your technology or the mission of the business. And I think this is where climate tech and biotech startups have a unique advantage versus the next social media app. Is a lot of your business models, because it's in climate tech or health tech, have a positive impact on the planet, sustainability, improvement of health outcomes. So when you speak to angels, use the values, the mission, the impact of your company to appeal to them emotionally, because that is a big factor in terms of their decision. Little less so in VCs. They have a thesis and they kind of stick to their guns in terms of their thesis. But angels, I think emotion and affinity to you and your business model are very helpful. So let's look at average investment for both of these groups. So again, it's very hard to find reliable statistics. So I did source various opinions online. I also used my own experience, but broadly speaking, friends and family, what I have seen, and I've done more than 100 friends and family equity investments in tech companies, it's somewhere between $2,500 and $50,000 per individual. That $10,000 check, $15,000 check is very common. And for a friends and family round, I often see those minimum about 100,000 to 500,000 plus. When we get to accredited angels, there's a little bit better data out there. But what the data research shows is that the average individual angel typically invests between 25 and 100. I would say 25 to 50 is pretty common for the individual angel. And accredited angel groups, which we'll see an example in a moment, they're typically in for 250 to 1 million. Here's a great article on friends and family rounds versus angel rounds. So gives you a lot of great information about some of the differences between those two. So that, again, those links are live that you're going to get, and that's ready for you to read. Now, as we look at venture capital, you can see the difference here. See how the progression, friends and family, 500,000, accredited angels, up to 1 million. Now we're into, and this is fairly reliable statistics. VCs are much higher up on the food chart. So seed stage VC, the earliest, average investment is 2.6 million per company. Early stage VC 6.8, later stage VC 7.6. So you can see here that the amount of capital goes up substantially in VCs and even between types of VCs. So how does venture capital work? If you're looking at the approaching a venture capitalist, is what they talk about is the funnel, right? So all VC firms, all accredited angel firms, all they want and all they complain about not getting is quality deal flow. In this chart, it's leads. So the number one thing a VC firm wants and the number one thing an angel firm group wants is quality deals to put into their funnel and begin to qualify. So essentially that's where it starts. It starts with you making the pitch and that moving through their process. They do some initial screening typically just to make sure it's a structural fit. There's no fatal flaws. And then you may get a chance to present, meet with the partners, present in front of the group. If there's some traction on that pitch and they like it, they'll typically enter due diligence. We'll talk about that in a moment. Those companies that get through due diligence actually get a term sheet, and then many of those deals are closed. So there's a big funnel, and a small percentage of those deals actually make it to funding. So why is that important for you to know? Know that it's a long road. Know that it's a challenging process. And your job is to make your pitch and your business proposition quality, so that you can start to move through that funnel and not get kicked out at the very earliest stage. So roughly speaking, how does this all work, right? How does this whole process work with investors? Generally, what you need to have ready is you need to have a pitch, maybe a business plan, financials. You want to identify qualified investors. We're going to have a little exercise to do that. Make the initial outreach. I'll show you an example of how not to do outreach. Your whole goal is to secure the pitch, right? That's the whole milestone you're looking for, is that first pitch. If they like the first pitch, typically VCs will schedule additional meetings with partners, more pitching, detailed review of the business plan, overview of the financials, start to get into the team. If they like that, they start their due diligence, issue a term sheet, do the docs, and then the funds are deposited. So you can see here, basically it goes from you preparing the pitch all the way to funds deposited. So team. According to a survey of 885 VCs from 681 firms, team was mentioned as an essential investment factor by 95% of respondents. Investment strategy, product, business model were all important, but they were way down the list, okay? So why is that important for you? First, a lot of VC firms won't invest in solo founders, so they need a complete team. Probably a lot of you don't have a team. Maybe it's just you. So what do? You begin to look for advisors, mentors, other team members, key firms. Anything you can do to broaden your skill set on your team, and to make sure that you can present to a potential investor. We have a complete team. We have the people necessary with the skills, qualifications, education, experience to drive this particular business model. Here's a great article on how venture capitalists evaluate successful startup founders. So it's got some really good stuff in here. And you can see here that team was number one, and investment strategy and everything else was way down the line. So really encourage you to check that out. Due diligence. What is due diligence? Essentially, it's kind of like you bought a house or put an offer on a house, and now the inspections start. So it's the inspections. And due diligence, there are due diligence checklists out there that are 20 pages long. VCs, angels have different levels of detail in terms of due diligence, but the important thing to know is you've got to have your support docs ready, and that everything that you put forward in your business plan, you have to have that in real life. I mean, like, you can't fake it to make it, because that will all be uncovered under due diligence. So there's a lot of great information on due diligence checklists and how to prepare. But here's a really good article I found on a guide to venture capital due diligence. So it's a great read, and it'll take you all the way through all the main areas of what a VC is going to look for. We will have questions coming up in just a moment, so get ready to ask any questions on due diligence. I want to, people talk about, well, how's this deal going to be structured? Is it, what's the valuation, and is it preferred or common? Really, for most early stage tech companies now, it's the safe note. That's the dominant method to fund. It's simple agreement for future equity. It was kind of pioneered by Y Combinator. And it's really a much faster, simpler, cheaper, less expensive way to secure early stage investment. Here's a really good resource for you. This is from Y Combinator, and it's basically got templates for the documents. There's a lot of great information out there online on the pros and cons of safe notes, but you can check that out for further information. At the end of the day, the big benefit of a safe note for everybody is it delays the ultimate valuation question to a later round of financing. So safe note has largely replaced almost everything else in terms of early stage deal structures. Woo! All right, gang. So what's coming up is a little bit of conversation of how you identify VC and angel groups. I can't see chat right now. So Cameron, would you be so kind? If there are any questions, could you throw those out?
Yes, we had one question that came in. It was fairly specific, but what would be a good cap for a 2 million valuation and 50% note, 50% safe?
Can you give that to me one more time?
Yeah, yes, sir. What would be a good cap for a $2 million valuation, and 50% of it was a note and 50% of it is a safe?
Let's do that. I have some kind of contextual questions I'd want to ask about that particular one. So let me push that off if I could. And I'm not sure if the panelists have any thoughts on that, but I would need some additional details to be able to respond to that. So maybe I can do that one-on-one, and I'm happy to put my email in the chat, and would be happy to address that question in much more detail. But I wouldn't be giving it justice without asking some additional questions.
Totally makes 100% sense. That was the question that I on there. So you're good.
Perfect. All right, let's keep going. So just a reminder, guys, we do have the investor panel coming up. Please direct chat me any and all questions that you would like to pose to one of our panelists. So please, just a reminder to do that. We want to make that, this is your time. Any and all questions that you want answered by one of our panelists, direct chat those to me, and we will include those in our Q&A. So how do you identify the right VC and angel group? First, if we think about VCs and angels, they typically, and we should be talking about accredited angels. We're kind of outside friends and family now. But when we think about VC firms and accredited angel groups, primarily each one has an investment thesis or philosophy. And it's defined by the sectors they invest in, the amounts of capital they invest in, the stage they invest in, and the market potential of the company. Here's a real good article on 11 VC firms in San Francisco. So if we kind of look at this, I'll just take the first one. This is Excel Ventures. That's a very well-known VC firm. There's a lot of information here. And again, we're going to look at a VC firm, but it's a leading VC firm, so it's active. It invests in early phases of a company. It's industry agnostic, so they're open to all types of industries. They invest in many stages from pre-seed to very later stage VC. Okay, so and they're they're local. These are all important things to know about a VC firm. So that's the type of information you're going to want to start to gather about a firm. First thing to think about is sector. Okay. So even within biotech, there is versions of biotech. So I want you to think about investor readiness. The first thing you want to do is kind of define your overall sector and then your particular niche within that sector or vertical. So are you biotech, pharma, therapeutics? So you want to make sure that you have the right broad sector and perhaps the right verticals so that you can better align with potentially the investment thesis of any given investment firm. Same with climate tech. There's a lot of different versions of climate tech. So it's important for you to understand what sector and what verticals so you can start matching up against investors. So let me show you what to look for. So the Band of Angels is a really popular Bay Area angel investment group. And I want to show you what you should be looking for. So if you go down here, you're going to get basically exactly what they're looking for. So they are telling you exactly who they want to apply. Seed stage, high tech, life sciences, strong teams, proprietary technology, big markets. And your goal is, if that's you, to highlight how you fit exactly that thesis and why they should start to put you in their deal funnel. Okay. So they're telling you also right here how much they invest. Okay. The things they don't invest in. So the takeaway here is, don't spend a lot of time spraying and praying pitch decks. Be very strategic about your research and only focus on those firms that match up against what you're offering.
Now,
Same with
Paul,
Sequoia Capital. Yeah, go.
put some emphasis on that, just in
Please.
between there. So to be clear, my fund is early stage enterprise technology, B2B SaaS. I cannot tell you how many emails I get every week congratulating me on my track record in the cannabis industry or healthcare or deep life sciences, right? I don't even read the emails. It just shows the founder did absolutely no research. And as Paul just said, spray and pray. You're just wasting everybody's time by doing that. Go in and read these things and figure out, what does this firm want? And do I want this firm? Because if someone had the misfortune to actually get my attention and get my investment in cannabis or life sciences or something, I got nothing to help with. I'm not going to be useful to you in any way. So it's just a mismatch from the get-go. Don't do that.
Thanks, Steve. Let's look at Sequoia Capital. Sequoia Capital is a very big VC firm. And if I was looking at them, I would say, okay, here's our companies. Okay, great. And then let's see, category, climate tech. Okay, cool. That's good. I am a pre-seed climate tech. All right, great. They've invested in, looks like 4 pre-seed climate tech companies. And I could even look at these 2 and say, okay, is this me? So do I look like this company? Because if I do, I've got a pretty good chance of potentially getting funded by Sequoia. Okay, so this is the research that needs to be done in order to make sure that you're only spending your time submitting viable applications and increasing your hit rate of potential pitches. Also, I won't go through all of these, but I want to make sure you're aware that there's some great accelerators out there. And so there is a link to each of these. Let's just take a look at Techstars. So again, I won't go through all these, but I want to make sure that you're aware that accelerators also are potentially a great source of funding, but you have to be very select about the accelerator that you work with. So I've included 5 or 6 of the top tier ones. Most of those offer funding as a part of their program. So you're welcome to click through to each of those and learn a little bit more about their programs. So let me show you what not to do with investor outreach. And Steve, I think you were just talking about this. I get these emails all day long, okay, because everything on my LinkedIn profile is about investment and tech. So I get these all day long, at least one a day, sometimes two. And it's this generic outreach of, um, why their company is great. And so you can take a look at it. I redacted all the specific information. And these go right to my spam or block folder. I don't even look at these anymore. So the concept of just randomly emailing people that you have zero connection, have done zero work to build a relationship with, is a losing strategy. I'll just eliminate that from your portfolio. They don't work. I call it over the transom. So a lot of these VC firms will have submit your pitch deck here. Realize that they are getting thousands of pitch decks a month from every place on the globe. Okay. That is, generally speaking, the wrong way to engage with an angel firm or a VC firm. So let me show you the right way to engage with a VC or angel firm. So if I'm looking at Band of Angels and I realize that I fit their investment thesis, I'm going to do some hunting here. And I'm going to go to our team. Okay, let's see. These are the team. Okay, good. These are our deal screeners. Okay, I want to know about these people. Okay, so it looks like Ron is, I'm a software company, and Ron is the person that is one of the deal screeners for software. Okay, so I'm going to figure out, do I know somebody that knows Ron? Can I connect with him on LinkedIn and establish some rapport? Can I begin following his X profiles or any other things that he's doing? How do I begin to build some form of initial connection, rapport, or relationship with Ron so that he might actually look at my email and not block it and not send it to spam? Because Ron is the entry point to this particular angel group. Okay. So that's the way that you look for individuals. Same with the VC firm. I'm looking at team. This gentleman, Julian, is seed and early stage. I'm seed and early stage. Let me look at his profile. Okay. He's telling us exactly about him, what he's looking for, and the ability to actually get in touch with him. Okay, that's very rare. Normally, they never have their direct emails. But do your research. Just as Steve said, show that you know who they are and why your company is an exact match for their investment thesis. Few more things. Elevator pitch. One thing investors or entrepreneurs struggle with is when somebody says, tell me about your company, they go off, right? Like, just there's so much to say. You've got to have a clean, succinct 30-second pitch that tells the potential investor about your company, what's unique, novel about what you're doing, your team, the customer problem, your business model, whatever elements you put into it. But have that at the ready. That's an important tool. So have a quick, polished, refined, succinct elevator pitch that you can get out quickly in the moment. It takes less than 30 seconds and it's compelling. I've got a great link for a good article just with some examples and some basic approaches to do that. Good. Cameron, any questions?
While people are thinking, Paul, if I could add one thought to the elevator pitch that a friend introduced me to a couple of years ago. That's, everybody's heard of the, 30-second, minute, whatever it is. The next most important thing to think about is, what's the coffee conversation? What I mean by that is, okay, Lee or I sit in our conference room on our Zoom. Maybe we see 6 pitches in a day on a Tuesday. Okay. I take a break. I walk down the hall to get a cup of coffee, and my partner says, have you seen anything good today? Or that one, those slides looked interesting. What was that? what's the 20 seconds you want me to tell my partner so that he or she says, ooh, that sounds interesting. Can I be in the next meeting? Right, which is another standard above the elevator pitch, but that's when you really start to get traction into due diligence. And remember, I may be jumping the gun here on red flags, but your first meeting, you have one goal: get the next meeting. Too many founders come in thinking they're going to say everything and get a term sheet, and that's not how it works.
Yeah, and I mean, unfortunately, this is one where every VC is going to have their own view, every angel is going to have their own view, but I do think that you need to focus on what's your product, why is it unique, what is it, and how do you do something that nobody else does. I mean, I got a slide deck the other day. It was 37 pages long, and by the time I was on slide 30, I still didn't know what the product was. You know, most of the time I don't get to slide 30. It came in through a friend, so I actually paid attention to it. Normally by slide 3, I'd be like, delete. So you've got to get their attention quickly, whether it's elevator pitch, whether it's slide deck of, here's my product, here's why it's unique, here's the customers that care about it. Okay, once you get my attention, now I'll pay attention to everything else. What school you went to, where you worked, what your dog's name is. Other than that, I don't care.
Great, great input. Just a quick timing check. I do have a few more things to talk about. So what we're gonna do, I'm gonna pose this as our thing. We're gonna have a hard stop at 1:20. So just a heads up. I need about 7 to 10 more minutes to do the rest of the content justice, and then I do want to open up for our investor panel. So just a heads up in terms of logistics, but we will have a hard stop at 1:20 exactly, and we're going to save at least 10 minutes for our investor panel questions. So that's good with everybody. I'm going to efficiently, thoughtfully, but succinctly go through the rest of the topics, so we have plenty of time for your questions. So just a heads up. Very brief conversation about SBIR STTR grants. Essentially, this is the Small Business Innovation Research Grant. It's a very large program, over $4 billion in funding each year. Half of that goes to DoD projects, but the other half is up for grabs. There's some great information right here, sbir.gov. So I'll let you look at that on your own. There's roughly some phases. Probably where most of you are at would be phase 1, and this is really research, concept validation, idea evaluation. These grants can go up to $250,000. Later stage grants can be up to $2 million. So really there's a phase 1 grant that's just for kind of pre-seed research, validation, those type of things. So that's a great option. What I really like, and a lot of people don't know about this, is most of the times you have to respond to a grant solicitation, but NSF actually allows unsolicited pitches, and they do a lot of the funding for the groups that might be in our conversation today, climate tech, biotech. So if you have not heard about the NSF project pitch, I would absolutely check this out because it's a quick pitch. You throw it in, and then they invite you to submit fully. So really check out the NSF project pitch. Several of my clients have used it with much success. So I absolutely want you to know that that is available. Grants.gov, it's kind of a national clearinghouse of everything to do with government grants. It's a bit of a minefield, okay, but you can search for grants by, let's say, energy, and you can even establish, what agency you want to see grants from. So maybe it's, whatever it is. So let's see, maybe it's all Department of Energy. So there is a way to kind of start to sort through and see if you have grants that are available to you, but it's a bit of a bureaucratic minefield, but I want to make sure that you're aware that it's out there. We'll skip questions for right now. Okay, this will be kind of the last big topic conversation. I'll have a little bit on IP, but I want to go over some themes about entity formation. So there's a lot of choices in terms of legal entity. I'm just going to shortcut it. It should be a corporation, not an LLC or an S corporation. Many VC firms, angel firms will not invest in LLCs or corporations. Here's a great article of why you should choose a corporation. What are the pros and cons? So again, in the essence of time, I won't go through all the details. This is a fantastic article, very comprehensive. The key takeaway for you, your route, if you're going to secure larger amounts of funding, C corporation, and recommend Delaware. Delaware is a very popular choice for startup companies. It's got an excellent corporate code, long established. It's known for very proven comprehensive framework for corporate governance. And here's an article on why VCs prefer Delaware C corporations. So again, I'll let you read that. In fact, 80% of all US IPOs are formed in Delaware. Board of directors. Board of directors should be a very strategic choice in terms of who those individuals are. But ultimately, they represent the shareholders. So you have your board, you have your operating officers, you have your shareholders, and the board represents the shareholders' interests. Be very strategic in terms of how you compose your board. Here's a great article on what startup boards are and how to build them. So again, in the essence of time, I won't go through all of this, but this is super, super detailed. Who gets equity in a startup? A lot of people get equity. Okay, here's an article on how to really think about distributing equity and splitting that up. When people get equity, what type of equity, who gets it, factors in deciding how much and to who. So that will help guide you. Usually the bigger conversation is how much equity each founder gets. I won't go over the equity pie, but essentially when you form a corporation, as you get funding, entities own different parts of that corporation. So just embrace the concept of dilution. It's not a bad thing. Vesting agreement, very important that founders are under a vesting agreement that essentially allows them to earn into equity over time based on service milestones. So the last thing you want to do is grant and immediately vest a large chunk of equity to an individual, only to have them change their mind and bail and go get a day job or decide to move to Jamaica. So typically that equity is distributed over time. Oftentimes it's 36 months, called the vesting schedule. Here's a great article on how vesting agreements work and how to form them. So that's available for you. How to issue equity to advisors is a big question. Similar to Safe Notes, there's a standardized agreement template for advisors. It's called the FAST agreement. And here is an article on that. So it's a really good template to determine how much equity advisors get and an actual agreement template. So again, what we're trying to do is standardize these common things like, Safe Notes and FAST agreements to make it simple, fast, and easy for your company. Cap table is basically an itemization of who owns what and what kind of equity and what percentage of ownership. Here's a great article from Carta. They're kind of the leading voice, if you will, on cap tables. So I won't go through all this, but having a clear cap table and a detailed cap table is essential for you and every investor, both now and in the future. All right, good. I'll skip questions. I have a little bit of primer on IP, and then we're going to get to our investor roundtable. So last chance to put questions directly to me that you would like to pose to our investors. So that's coming up in just a couple minutes. So intellectual property, patents in particular are a big one. They can be very important to protect unique, novel, and proprietary innovations. They allow you to protect them. They allow you to potentially attract investors. They can be helpful in securing partnerships, and you can monetize those. Trademarks, to a lesser extent, are kind of VC centric. But if you are building a brand, trademark is very important to protect your brand name. So I think understanding trademarks in your company is important from an investor readiness point of view. The last thing you want is some other brand, addition your good name. Here's a good article, 7 reasons why trademarks are important for startups. Don't do it-yourself patent work. Please hire qualified patent specialists. The quality of your patent is dependent upon the filing of your patent. If there's weakness in the filing, gaps in the patent, it just negates the entire strategic value. Hire professionals. It's not cheap. It's worth every penny. Here's a great article from TechCrunch on all about when to patent and perhaps when not to patent, and a little bit about provisional patents, which is a good entry point. Lastly, or coming to the close here, you have to make sure that everyone's that is contributing intellectual property, ideas, concept, and other novel work, proprietary stuff, they have assigned that to the company. They don't own that personally. That's called an IP assignment. Very, very important to secure. And here's a good article on why IP assignments are important for startups. And that link is loading slow, but it is live, so it's available to you. All right, if you get a patent, that's great, but you got to defend it. The average legal fees for patent litigation is $2.8 million. So just to have a heads up, it's great to get. It may be very important. It's prudent to investigate that. But if you're going to get one, you got to defend it, and you should have some deep pockets for that. Woo! All right, gang, we have arrived. We have some time at the end for our investor speed rounds. And just a reminder, here's our panel, myself, Steve, Jeff, and Lee. So if all of our panel could get ready, I'm going to come off, and thank you. So I'm going to come off screen share.
All right, Paul, while you're catching up on the direct messages,
Thank you.
One that came in through the general chat that I have my answer, but I'm sending it to Lee first.
Go.
Could a 2-minute video showcasing your idea capture attention more effectively than a traditional pitch deck that investors might quickly skim through?
Yeah, honestly, I think if it's well done and it hits the highlights and it's engaging, yeah. And just being realistic, we're usually trying to fit reviewing these into when we have free time. So I can watch a video on the Stairmaster or listen to it while I'm driving. So yeah, I don't think it's a bad idea, actually.
Good. Let me pose one.
Steve, I'm curious your answer. Do you agree or do you disagree?
I think I would put the context around it of what Paul said earlier. If it comes in unsolicited, I'm not even opening it. I have to have a context for why I would spend 2 minutes on the video. If it's from a stranger, forget it.
Yeah, this is, I've got some questions. So we've got some, and please continue as we're going through these things. Please continue to put questions. Let me pose this to our panel. What strategies and tactics do you suggest as the best ways to get investors if you don't have a lot of connections in the investor space? Hey, Lee, can I throw that to you first? So, what gets your attention? If, what strategies would you suggest to a founder about developing connections, rapport, and interest from potential investors? Any thoughts?
I mean, there's the obvious one we've all said. If you get it to come in through a contact, that's better. If you don't have the contacts, and again, you're going to get 10 answers from 10 investors, but I like concrete bullet points. So, if you can tell me right off the bat, I have 3 customers that are piloting, I have something working, I've actually made a product, I have been able to sell 10 of them. give me some really concrete information that makes me think it's real, and then maybe I'll keep reading.
All right, good. Hey, Jeff, would you take this one?
Sure.
Okay, great. How much should take into account how competitors are securing funding when plotting our own path? So, Jeff, when you think about going for investment, how important is it to think about the competition? And from an investor point of view, does it matter if other companies like mine are getting funding, or that doesn't matter to you?
Well, a couple of things. Number one, and anybody can correct me, but when I was back in my investor day, certainly don't approach me if I've already funded like a direct competitor. That may sound silly, but I used to get approached a lot. It's like, oh, you invested in a company that's really similar to ours. You want to invest again? It's like, probably not. And you probably don't want to talk to me, because if I happen to sit on their board, then you're going to be giving me a bunch of confidential information, and I'll never sign an NDA, by the way. So, but I do think there's some validity around if it's a well-defined category versus a category that hasn't been defined before. I mean, if it's a really pretty well-defined category and there is a pain point, and even if others have got investment dollars in advance of you, there could be an opportunity, to kind of ride on some coattails there. And what I mean by that is, I'm just going to pick some silly examples, but say there's a category and 10 different companies got invested in that category. Typically over time, one's going to be the gorilla, one might be a monkey, one might be a chimp. One or two or three of those, if that category is valid, those 3 out of 10 might have a real chance to, have a go at it. The other 7 may or may not. But my point being is, yeah, look at if the competitor is getting financed. Look at what stage. How are they doing? Are they further along? And do your homework. So,
Great, thank you.
Lee, Steve, any thoughts?
I would add something which is sort of a little orthogonal, but it just made me think of it. And I'm sure someone will have data to prove me why I'm wrong on this. But the whole, we're the first one, so we have a first mover advantage. Generally, I don't buy that. And I can think of so many cases where somebody was the first one, they beat their head against the wall, convincing the market they wanted it for 10 years, and then somebody else came in and captured the market. So, I think to the question that was asked, being the second or the third or the fourth doesn't bother me at all. Being the 200th, yeah, okay, it's probably a little late.
Good point.
Let me, this one's a good one. I'm going to actually pose this to Lee and Steve, and I want a super quick, kind of top of mind answer. This is a good one. Could a 2-minute video showcasing our idea capture attention more effectively than a traditional pitch deck? Lee, what do you think? 2-minute video?
But we did that one.
We did it. That was the
We
first
did
one
that?
up on the chat. We did that one.
Oh, perfect. Okay, great. That's a good one. Hang on a second here. Sorry, I'm going through this. Let's see, there's a couple good ones. Sorry, there's a few. I'm just looking through these. Steve, I don't know if you see any questions in there that you want to grab. Okay, here's a good one. Does the fact that a company has been around for a while, a startup that was established 7, 8 years ago, does that make a difference? Lee, what do you think about a startup that's raising early funding that's been around for 7 years?
It's very contextual. So, with one of my jobs, we look at very, very early stage, super deep tech. If it took them 7 years to get it to work, maybe I might look at it. If it took them 7 years of wandering around in the wilderness and now they're going to try again down a different path, So I think the short answer is generally it's a little bit of a red flag, but it depends why.
Yeah,
Okay.
I would.
Steve, Jeff, any thoughts?
Yeah, I'd add to that. How much capital did they consume? right? And yeah, okay, deep tech, I don't know, clinical trials, and you've spent 7 years getting through, phase 2 or phase 3, and you haven't spent, $400 billion on it. Sure, if I were in life sciences, biotech, I'd look at that. Enterprise software, you've spent 7 or 8 years and spent $20 million. Go home, close up shop, come up with a different idea, do something else. It will never, ever get funded. So it is contextual. It depends on the industry, and I mean, my conclusion, branching off a little bit, my conclusion at this point is one of the single greatest indicators of future success is how capital efficient a company has been to get to point XYZ, right? And if they've spent very little, I'm really interested. If they spent average to a lot, no, thank you.
I got one for the panel open. How important are financial projections when I do my pitch or initial investor outreach?
I'll take that one. I think they're really important. The first things, the first couple of things I want to get within the first 5 minutes, that's going to be one of them. What are the unit economics going to be profitable? And sure, enterprise software company, maybe for the first couple of years, they're not going to be, but you better be driving towards 80% gross margins after 3 years and whatnot. So I think it's really important. I think bottoms up, there's a lot of assumptions built in. It's more of an art than a science, but I send folks home immediately if they just give me well, here's our revenue projections because we're going to capture 50% of the market. And it's like, what's your underlying expense structure and your unit economics? I send them home right away and say, come back and maybe I'll review it again if you do some bottoms up forecasting.
Steve, financial projections, big deal.
I would add to that, and I like the way you framed it, Jeff. Take exactly what he said, but then give me something concrete so I believe what you're telling me, whether that's what you've done over the past year, a competitive company, you can show me some details. Anybody can come with a spreadsheet that looks wonderful. Yeah, I don't believe any of them. There needs to be something concrete as to why I believe what you're showing me.
Yeah,
Steve, projections?
This is a bit of a hot button for me, personally. Look, any set of projections is just one version of what's not going to happen. Right, we understand that. Every plan is wrong. Some of them are useful. And so I know in my industry, what are the ratios I'm looking for? What's the year-on-year growth should look like? What's the revenue per employee should look like? What are the bandwidths that your R&D spending should look like as you scale as a percent of revenue, right? Because I get things that come in, and literally, not so much anymore, but 2 years ago, I was getting plans where by year 3, this software company was going to be more profitable than Google. And by year 5, they will have gone faster in revenue than Twitter. Okay, you're just an idiot. You just didn't look at your industry. You have no understanding of how this business works. And so my answer on the financial projections is know enough about your industry, everything Jeff said, everything he said, that the business model hangs together. And don't promise me something that has never been done. It's insane, right? Even if you get funds, you've got a target on your back.
One footnote too I have on this, and I can't tell you how many times I see this. It drives me crazy growing up, with a quote on my back is enterprise software companies, they'll come in, I'll drill down on the assumptions around what's the lead time to close the sale. And they'll say, well, geez, we got, one of the first or 2 early adopters were friends of ours. We were able to close that deal in 2 months. So every deal is going to close within 2 months. It's like, no. And then the other thing that drives me crazy is they'll bring in salespeople and, they're going to be productive business within 30 days. If it's an enterprise sales cycle, you're talking about millions of dollars worth of potential procurement. It's going to take somebody X number of months to come up to speed. And then it's, maybe it's a 3-month sales cycle. Maybe it's a 12-month sales cycle. Don't tell me it's 2 months. That is a real pet peeve of mine too. But I see it all the time.
I think that's so true. I mean, we're going freeform a little bit. I'll throw this in here, but I think such a hot button and proof point for me is, have you been able to get somebody to pay you for what you're doing or going to do? And, anybody that comes in is, I get this great idea. And once you give me some money, I can build it and I can do marketing and I can buy a Super Bowl ad and then somebody will buy it. Like, honestly, the best companies I found on a shoestring, they've managed to get somebody to pay them something because what they're doing is interesting enough. And if you lead with that, okay, you got my attention.
All right, we're gonna end with one question, and it's gonna be posed to all the panelists. I'll even participate, but I'll be the last one, and then we're gonna wrap. So this is the final question. Okay, it is. And actually, I'll do the first response. That'll give our panelists a few moments to compile theirs. What is the biggest mistake you see in pitches? What is the biggest mistake you see in pitches or pitch decks? I think the biggest mistake I see most commonly is an underdeveloped customer problem or market need. Okay. That should be the front end of your pitch deck. Is what is the market problem that you're solving? What is the market gap? What is the market opportunity? I want to know what it is. I want to know how many people have it. I want to know how fast that problem is growing. And I want to know the cost of that problem, dollars, health, whatever it is. So, because unless you've got my attention there, the rest of the pitch doesn't even matter to me because there's nothing to be solved. So for me, the biggest mistake is an underdeveloped customer problem or market opportunity. Let's go to Jeff. Jeff, number one mistake in a pitch.
I can think of several, but
I'll cover, you know.
okay, you guys can fill it. You know, Paul is a little riding on your coattails, but customer validation is really important to me. I work with a lot of technical founders, and lots of them are extremely successful. But it's the age-old problem, which is it's a solution looking for a problem. I've become a really big fan of the NSF I-Core program that will pay early stage companies $50,000 to go out and do 150 customer interviews. I love it. So, you know, I want to see proof of real customer validation. Now, they may be before that stage, but that's a really big pet peeve of mine. If you haven't talked to any prospective customers, and it better not just be 10, make it 50. And you don't bring that up very, very early in terms of, you know, when you go into your pitch deck, the first thing I always like to look for is what's the problem you're trying to solve? What's the hair on fire issue? And how have you validated that?
Great. Thank you. Lee, number one mistake in pitches.
I mean, I'm going to go a little more generic and, you know, forgive me if this sounds professorial, but it's people don't edit their pitch decks enough. And by that, I mean, you get one shot, you should have spent weeks on this thing. And if there's any picture, any word, any graphic, there needs to be a reason it's there. There's so many pitch decks I see where it feels like they threw these things together the night before and it's word salad. Just edit these things mercilessly until you have the absolute core of whatever you're trying to say, and then go find an investor that resonates with. But just take everything out that doesn't have to be there.
Right. Steve?
I guess I'll riff on that. Yeah, like Jeff, I could put out 5, but my one is in that process of spending weeks on it and making sure the visuals are all correct. Make sure that it's the consistency check. And an example I'll just riff off something Jeff said a minute ago. If your sales cycle is going to be 6 months, your price point better be in 6 figures. And your channel's going to be direct. If you know, I love the $100,000 average sale price with a, you know, 2-year sales cycle and indirect channel. No, the logic makes no sense. That's not how the markets work. Your price point, your channel, your sales pitch, your unit cost, your unit time, all have to be consistent. And as Lee said, if you throw it together the weekend before, you haven't even looked at those ideas.
Great. Well, it's 1:20. I promised to wrap at this point. I want to thank everyone for participating today, participating in the series. Steve for his great work getting us to this point. Particularly, I want to thank our panelists, Jeff, Lee, and Steve. And Lee joining us kind of last minute to participate. A special thank you. And thanks for a great series, everyone. We hope it was helpful and valuable. I enjoyed being a part of it, and wish you best of luck in your ventures.